Welcome back to the show. Now, in The Dollar Trap, Professor Eswar Prasad wrestles with how the U.S. dollar has retained its prominence despite the great financial crisis. Now, his view, belief in the safety of the U.S. dollar means the dollar will remain the world's reserve currency. Now, I wanted to get Eswar's take on what's happening with Asia and the emerging markets, especially given the monetary experiment undertaken by central banks around the world right now. Now, I first asked him if there is a looming currency war in Asia right now. Here's what he had to say.
Asian emerging markets are caught in this very difficult bind because even though the U.S. has announced its tapering operations and interest rates at the short end are likely to rise in the U.S., conditions have stabilized and money is flowing from the U.S. to emerging markets, including Asia. Japan is freeing up monetary policy. The ECB has indicated it wants the euro to depreciate, so they're also going to be putting money into other emerging markets. And China is not allowing its currency to appreciate. So Asian emerging markets like Thailand, Indonesia, Korea feel stuck. And what are they going to do? They're going to keep their exports competitive by accumulating reserves and intervening in foreign exchange markets. So I suspect currency tensions are certainly on the scorecard.
Okay, now, Eswar, it seems a little bit perverse to me that in the last crisis, the dollar strengthened, a little bit perverse, but even more that capital often flows from emerging markets to developed ones. What's going on with that? What's the story with that?
Now, this is something very strange. In principle, capital should be flowing from the richer countries to the poorer ones. But the problem is that the poorer countries don't have enough capacity to absorb all this money coming in. And also, they don't want their currencies to appreciate, because if their currencies were to appreciate, which is what would happen if capital flowed in, that would make their exports less competitive. And many emerging markets feel that having exports is going to be very important for their growth strategies. So they're trying essentially to export capital, which is what China has been doing, for instance, in order to keep the renminbi from appreciating. And this has led to these very strange flows of capital. But the additional problem is that any time there is turmoil anywhere in the world, in the US, in the Eurozone, or in emerging markets, people want safety. And when they want safety, where do they come? Ultimately, they come back to the U.S. dollar.
Now, speaking of crisis in general, because we've been focusing on that a lot, whether it's currency or some other form, some of our guests are skeptical about the benefits of financial complexity in general. And, do you think that financial deepening, meaning that an increase in sophistication in finance, like the world of finance, is a good thing, or does it lead to more systemic risk?
It depends on where you're starting from. If you think about emerging markets like China and India, they need financial market development. They need a broader set of markets like corporate bond markets, even derivatives markets. I mean, we speak with fear about derivatives markets because in the US and perhaps in Europe and the UK, they've gotten out of hand. But there is a real need for derivatives markets for traders who want to hedge risk on exports and imports. So in fact, I think we will come to a somewhat happier middle where there is a restraining of finance in the advanced economies and a development of finance in the emerging markets, which really need better financial markets, which need better access to the financial system. So I hope that there will be a meeting somewhere in the middle.
Okay, now, is our current monetary system flawed in that, if it is, in fact, flawed, how do we make it work? How do we fix it so that it can move forward?
I think the biggest issue right now is that there is too much dependence on monetary policy. If you look at the U.S., fiscal policy was not supporting the recovery, and there are many reforms we need in the U.S., even tax reforms, for instance. None of that is happening, so monetary policy is carrying the entire burden of trying to support growth, maintain inflation in a reasonable range, prevent the stock market from getting too far ahead of itself. And this is true around the world. The Bank of Japan, the European Central Bank, and even emerging market central banks are being asked to do too much. And monetary policy, because you have more financial integration around the world, has spillover effects, which is unavoidable. So I think that's the key problem we need to fix. In every country, you need a better mix of policies, especially structural reforms. And we also need reforms to the global financial system, where, for instance, emerging markets don't feel they have no alternative but to self-insure, that is, accumulate currency reserves to protect themselves from all this capital flow volatility.
Now, how do you think the present system compares in terms of robustness to other monetary systems? or in monetary systems of past.
Now, many people have argued that perhaps we should move back to the gold standard. I don't think that's going to happen because, as we learned from the previous crises, if you don't have the ability to provide a lot of liquidity in a time of crisis, which is what a central bank like the Fed can do very effectively, that can make things worse. And a gold standard would constrain liquidity. If you think about fixed exchange rates, which some have argued would work better, or a single currency, there the reality again is that with lots of capital flows around the world, the exchange rate actually acts as a very useful shock absorber. So giving that up would not be a good thing, especially for emerging market economies. So I think the real focus should not be on trying to fix the monetary system, but in terms of trying to get better financial markets, better financial market regulation, and structural reforms in these countries so that the burden gets taken off a monetary policy in particular.
Now, in your book, The Dollar Trap, it goes into some detail about, the backdoor scheming, basically, that has happened in the monetary system era and in eras past as well. So could you give the audience your take on one of the more colorful episodes of schemery?
Well, the G20 meetings are always interesting to think about. And in fact, there was a period when French President Nicolas Sarkozy felt that it was very important to try to become friends with the Chinese by arguing that the renminbi should become a major currency. In fact, there was a conference that the French had proposed to the Chinese, which they resisted, but which finally they put together, and which a few academics were present at as well, but lots of the most powerful finance people in the world. And Nicolas Sarkozy was pushing very hard, saying the renminbi should become a dominant currency soon. And the Chinese, on the other hand, were saying, look, we think this is a good idea for the short term, but hold on, because we think that this is both costs and benefits, and we don't want to rush ahead with this as well. So it was very strange to have the Chinese saying, let's take it slower, and President Sarkozy saying, let's go full steam with renminbi internationalization.
That was Eswar.